Good morning, ladies and gentlemen. This is Brad Matheny. It is bright and early Friday morning. I wanted to go over the error I made in posting out the MENT rotational modeling system update yesterday. As I was rushed to try to leave for about an 80-mile trip, I noticed a sell signal in the MENT rotational modeling system. Let me show you the MENT rotational modeling system charts. So down here near this low that occurred on the SPY, this is the daily down here, and this is the weekly up here. The system had turned red, and I had seen a sell trigger occur. This is what alerted me to the potential that we had a sell trigger setting up. Now, I need to be cautious of waiting till the end of the day to make sure we get a confirmed sell trigger. Same thing up here, waiting till the end of the week to make sure we get a confirmed sell trigger, and that is my error, my bad. Now, what we've done today, or as of yesterday's close, is we've rallied back up off of this low level down here, moved back into green trending, and as long as theoretically we stay above 395, we should be okay, I would assume. We are flagging out in a sideways trend here. We had gone long back over here. This was the end of day trigger on the 2nd, which would have got us in on the open of the price of the 3rd. But ladies and gentlemen, we could get waffled around over here if we move into this, say, 400 to 390 area and flagging continues. We could go bearish, potentially back into bullish. This is what happens. It's called the law of averages, or the law of means. Basically, as we flatten out, the rotational modeling system, which is what it is, it's the name of what it is a rotational system, looks for trending. If we move into sideways flattening near this, say, 400, 395 area, we could see some flipping back and forth between daily and weekly, which won't be horrendous. It'll just means that we're waiting for a trend to continue. Now, as of today, the S&P, or the ES, is down quite a bit. You can see intraday here on, this is a 24-hour chart, on the ES, it is still bearish. Okay, so we need to be very cautious that we could, unless we get some sort of a rally off of these lows today, we could still move into bearish trending by the end of the day today. And this is just the way it is, folks. Okay, so where we're at with this is we are back to SPY bullish trending. You can move more capital into cash. I think that would probably be a fairly smart move to protect capital against this waffling trend. We have, obviously, the Fed raising interest rates. We have potential conflict, extended conflict in Europe, which doesn't seem to be going away, in Ukraine. We have a tightening market. Long and short of it is I think the U.S. market's going to hold up better than other foreign markets. But, I mean, we are certainly not back in the, 2017, 18, 19 type rally phase, or even earlier. So being a little more cautious with your capital is probably fairly well warranted at this point. Now, I would like to stress the real estate update that came out yesterday, and this is really kind of distressing. This is another reason why you might want to protect some capital right now, and possibly, moving into hedging instruments as a way of protecting against risk. Now, the U.S. dollar has been moving higher. This is likely to be the case that the foreign market risk levels are excessive, and the U.S. dollar seems like a great alternative right now compared to foreign market risk. But if the U.S. real estate market continues in this lower extreme on the tightness ranking, and look at the seller desperation levels up to 126%, oh boy, guys, we haven't seen this in 8 years, 9 years. We have not seen this level of desperation and this downward sloping inventory strength in forever. Now, the heat rank has gone back to 0. This could be kind of a blip in the data, but I believe this weakening tightness level all the way down here to minus 100%. And the seller desperation level means that the bottom is starting to fall out of the real estate market, which could mean that we could see, 3, 4, 5 months of real consolidation in the market. We could see an extended downward trend potentially in the U.S. market, especially if this is going to affect finance or banking or credit risks. So we're at this very interesting juncture in the markets right now. You see from this level up here, this is COVID. This is our buy trigger back over here. We had gone into a beautiful trade, caught this buy trade, nice and solid all the way up, stayed bullish through this entire trend, still staying bullish, but we are flattening out. This may stay bullish in the long term, but this is the one that rotates around. This is the daily. And this rotates up and down through trends and tries to catch the broader cycle trend of the market. We're currently very close to moving back into bearish trending. We'll have to see where the SPY ends today. But again, my error in jumping the gun yesterday, you can see the SPY ended green. We may end up red by the end of the day today. The markets are down pre-market. I can see ES is down 24. NASDAQ is down 106. If we retest yesterday's lows on the SPY by the end of trading today, somewhere down below, call it 399 or 398.5, let's say, we could be in some real bearish trending territory, which would move us back into a protective manner. So again, the smart move as we're looking at this sideways volatility and the new real estate market data warning that there is an extended contraction likely taking place in real estate would be to protect your capital. Literally, the smartest thing you could do right now is take a conservative stance, protect your capital, realize that the risk levels are elevated, and even if we get a little upward trend in the SPY over the next 6, 7, 8, 12 months like I'm expecting, it may not be the same type of trend like we saw in 2015, 16, 17, 18, 19, 20, 21. I mean, this is a totally different market, and I fully expect the market, like I've been telling you, to stay in a sideways trend between now and November 2024 when we get the elections, the presidential elections. It's happened repeatedly in history that the 18 months or so prior to an election are very consolidated. What's happening right now is we have rising interest rates, fairly hawkish Fed, some global turmoil with Russia and Ukraine and the U.S. and what have you, and we have inflationary concerns where the Fed is trying to break inflation trends. So we've got a whole host of problems ahead of us. Now, that doesn't mean that the U.S. market can't continue to trend moderately higher. What I'm telling you is that I believe the U.S. markets will hold up much better than foreign markets, and I believe we have probably another, we won't see I've been telling you, I don't believe we're going to see any big trending, really, until sometime in 2024. Possibly closer to like August, September, October of 2024. But the reality is we've got a whole host of issues ahead of us for the next 16, 18 months before the election. And we may end up in a very tough sideways consolidation trend. And we could potentially move lower. We've got these recent lows back over here from October of last year, which is back over here. In theory, we could stay in this 335 to 420 range. We could stay in this range for a lot longer than many people realize. So stay fluid. Adjust your trading style to what the charts are showing you, and we'll go from there. Thanks, guys.